Welcome. In this video is ZBCN coin bullish wave coming. We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When we look at the current market structure, we can clearly see that the price is moving in a certain pattern and that there are specific wave formations behind these movements. Elliott wave theory, a deeply rooted and comprehensive concept within technical analysis, helps us understand price action by breaking it down into wave structures. Within the framework of this theory, it's possible to say that the price is currently in the second wave phase. The second wave is typically corrective in nature and represents a transitional period in which the primary trend that started with the first wave temporarily pauses, leading to profit-taking and a slight sense of uncertainty in the market. The second wave in Elliott waves is always corrective, and the third wave that follows it is generally the strongest, most aggressive, and highest potential upward move. Most of the major rallies in the market occurred during this third Elliott wave. At this point, market participants are usually convinced by the initial rise that the price is indeed turned upward, leading to an increase in buying positions and the formation of a strongly bullish environment. Assuming the price is currently in the second wave, it is expected that the third wave will begin after this correction. The third wave not only targets a new high, but also represents the largest portion of the long-term upward potential. Technically, this wave typically reaches a length 1.618 times that of the first wave. This ratio is based on Fibonacci levels, which are foundational elements of Elliott wave theory. However, in some cases, this third wave doesn't stop at 1.618. If the market gains strong momentum, it can reach as high as 2.272 level, and in rare cases, it might extend to 2.618 or even higher Fibonacci extension levels. While the price is currently consolidating or making a minor correction within the second wave, attentive technical analysts view this as a preparation phase. When the third wave begins, investors who miss the first upward move often look to enter, which causes bullish pressure to increase rapidly. When the price reaches the 1.618 Fibonacci extension level, this usually forms a strong resistance. However, if that level is broken, the next target is the 2.272 level, a point that typically marks the most prominent stage of the bull trend. The price's performance during this process also reflects the market's overall sentiment and psychological structure. The third wave often coincides with the height of investors' expectations, renewed optimism, and peak market sentiment. Thus, during this period, the price often tends to move upward continuously without making significant corrections. If the large green candles formed during this phase are supported by formations like bullish Marubozu or strong engulfing patterns, these are among the clearest signs that the third wave is in progress. Moreover, Fibonacci extension tools are not only used to set price targets, but also to understand wave structure. For example, the difference between the starting and ending point of the first wave is projected from the end of the second wave to determine the 1.618 and 2.272 target levels. These technical calculations allow traders to plan potential profit-taking levels or exit points in advance within the third wave. Considering all this, the current price action has not yet fully demonstrated its potential. Once the second wave ends, it is highly likely that the price will gain new momentum and move swiftly upward with the third wave. This movement, especially toward the 1.618 and then 2.272 Fibonacci levels, is one of the most commonly observed scenarios according to theory and past market behavior. Therefore, investors who closely follow technical analysis tend to optimize their buy positions by targeting these levels. At this point, another factor investors should pay attention to is the structure of the second wave. If this correction is shallow and horizontal, it often signals that the third wave will be particularly strong. This means the market has retained its strength without a deep correction and has stored enough energy for the third wave. Conversely, if the second wave is a deep and sharp correction, the third wave will still move upward, but may end around lower levels such as 1.382 or 1.5 instead of 1.618. In conclusion, when analyzing the current technical structure, it appears that, according to Elliott wave theory, the price is nearing the end of the second corrective wave and is expected to initiate a strong third wave movement afterwards. This move is expected to reach at least 1.618, ideally extending to 2.272 levels. Analyses conducted during this period, as well as oscillator signals and the formation of technical patterns, will provide investors with critical clues regarding direction. Therefore, closely monitoring price action and being prepared for potential opportunities once the third wave begins is of utmost importance for any investor seeking to maximize gains during this phase. But we can't make a decision based on Elliott wave alone, so let's take a look at other metrics as well. Stay tuned.
One of the notable structural formations on the chart is the double bottom formation, also known as the W formation, which stands out as a highly meaningful technical pattern under current market conditions. This formation typically occurs after a downtrend and serves as an important reversal signal, indicating the buyers are gradually gaining strength while sellers are losing their previous dominance. When we closely examine current price action, the first phase of this pattern appears to be completed, and the price is consolidating around the second bottom area. This marks one of the most critical stages of the pattern, the second bottom phase. When analyzing the general structure of the double bottom formation, we observe that the price drops to a certain level, then reacts upward, but this upward move is not sustained and pulls back to a similar level. This second pullback usually ends at a point close to the previous low. However, the key element to watch here is that the second pullback does not lead to a further decline and buying pressure re-emerges in the market. This stage is often seen as a buying opportunity by investors since the area is both near a support zone, implying low risk, and has a high potential for upward movement. When examining the current price action, the recovery following the first bottom of the forming W pattern made a move toward the neckline. However, it faced resistance at that level and retraced again. Currently, the second bottom is in the process of being formed on the chart. In technical analysis, this second bottom typically forms near the first bottom, and the reactions from this area provide critical signals regarding whether the pattern will play out. If the price initiates an upward breakout from this level, the pattern is confirmed, and the first stage of the upward wave begins. Additionally, during the second bottom phase, the price usually moves along a horizontal support band. Since this support band was previously where the price bounced upward, it holds significance in market memory. If this support band holds and the price manages to stay above it, this suggests that the bulls have regained control. A move upward from this point would bring the price closer to the neckline of the pattern. For the pattern to be completed, the price must make another upward move after the second bottom and break above the neckline level, which corresponds to the high of the first rebound. Once this breakout occurs, the W formation is technically considered complete and target calculations can be made. In technical analysis, the target of a W pattern is determined by measuring the distance from the bottom to the neckline and projecting that same distance upward from the breakout point. This typically signals a strong upward potential for the price. Currently, the price being at the second bottom represents a very critical window for investors. Observations and positions taken at this stage are advantageous both in terms of risk-reward ratio and for capturing a potential reversal early. Especially if the second bottom is forming as a horizontal or slightly higher low rather than a lower low, this suggests that the market is no longer allowing sellers as much control and the buying pressure is recovering. This increases the likelihood of the pattern completing successfully. Another important technical element at this stage is volume analysis. Typically, a decrease in volume during the second bottom suggests that selling pressure is weakening. However, the upward move that begins after the second bottom should be supported by increasing volume. This rise in volume indicates that investors now believe in the uptrend and that new money is entering the market. In such a scenario, the likelihood of the W pattern playing out becomes not just a possibility, but a strong probability. Once the pattern is completed, the price often rises sharply and quickly. During this rise, previous resistance levels can be breached rapidly as investors recognize the technical meaning of this reversal formation and position themselves accordingly. Especially after the neckline is broken, reaching the upward target levels becomes highly likely from a technical perspective. This target is typically calculated by adding the distance from the first bottom to the neckline at the breakout point. However, if there is strong buying pressure in the market, moves beyond these technical targets may also occur. In some cases, these types of formations are not only indicators of short-term moves, but may also signal medium and long-term uptrends. This is because bottom formations often point to trend reversals. Such structures do not only suggest temporary recoveries, but also show that the market may be preparing for a change in direction. Therefore, the W formation is considered a strong buy signal, not only by retail investors, but also by professional traders and large investment funds. In conclusion, when evaluating the current structure on the chart within the framework of technical analysis, it is clear that a double bottom formation is in the process of forming and is currently at the second bottom phase. This area should be closely monitored both due to previous price reactions and its psychological significance as a support level. If there is an upward reaction from this level and the price breaks above the neckline, it will signal the beginning of a strong upward movement in the market. Since such formations have a high success rate in technical analysis, the price action in this zone can present significant opportunities for investors.
When we examine the current market structure, it becomes evident that a notable formation is about to occur on the MACD indicator, which is widely used in technical analysis and closely monitored by investors. This indicator is considered one of the most reliable oscillators used to measure price momentum and detect potential trend reversals at an early stage. In the current chart setup, the distance between the MACD lines is gradually narrowing, and the two lines appear to be preparing for a bullish crossover. This potential crossover is typically interpreted in technical analysis as a signal of an upcoming upward movement, indicating a period where new buy signals may begin to emerge for investors. The MACD is based on two exponential moving averages, one short-term, usually a 12-period EMA, and one long-term, usually a 26-period EMA. The difference between these two averages forms the MACD line. Then a 9-period EMA is applied to the MACD line to generate the signal line. Crossovers between these two lines are considered among the most critical signals in technical analysis. A bullish crossover occurs when the short-term momentum crosses above the long-term average, indicating that buyers are starting to gain strength in the market. Such a crossover generally implies that the market is beginning to build strength and that the ongoing downtrend or sideways movement may be coming to an end. Especially when this crossover occurs while the MACD line is in negative territory, it gains additional importance as a hidden reversal signal. Bullish crossovers from negative territory often indicate that the price has undergone a significant bottoming process and is now ready to begin a new upward trend. This is a highly meaningful signal for both short-term traders and medium to long-term position investors. Investors use these crossovers not only as technical signals, but also to gauge changes in market psychology. A bullish MACD crossover shows that buyers are regaining confidence and sellers are starting to lose strength. At this point, investors typically begin to open new positions or increase existing ones. This shift in supply-demand dynamics in favor of the bulls often leads to more solid and sustained upward price movement. The current price structure and MACD indicator behavior may technically suggest that the market is in a preparation phase for an upward movement. After recent periods of sideways or downward movement, a MACD crossover of this kind often draws the attention of many technical analysts. This situation may mark the beginning of a potential trend reversal. If the signal is supported by other indicators, such as positive divergence on the RSI or upward expansion signals following a Bollinger Band squeeze, the likelihood of a bullish scenario increases even more. Historically, MACD crossover signals like these have marked the beginning of many major rallies. For example, when a financial instrument has been in a prolonged downtrend and a bullish MACD crossover occurs, the price often reverses direction in a short amount of time. This shift is usually accompanied by increased volume, a rise in buy orders, and heightened investor interest. Such a crossover can signal not only a short-term bounce, but also the beginning of a sustainable upward trend over the medium to long term. Another important element to watch is the MACD histogram. The histogram represents the difference between the MACD line and the signal line, and a rising histogram is often seen as a leading indicator of an upcoming bullish crossover. If in the current chart setup the histogram bars are shrinking and approaching the zero line, it suggests the gap between the two lines is closing and a crossover may occur soon. If the histogram crosses above the zero line, it further reinforces the bullish signal. MACD crossovers in technical analysis should not be evaluated as simply present or absent. The timing, location, relation to prior price movements, and alignment with other indicators are all critical. For example, if a resistance breakout occurs at the same time as a bullish MACD crossover, it may indicate that the breakout is more reliable and that a new trend is starting. Likewise, a crossover that occurs along an ascending trend line suggests that investors are supporting the trend and the price may be preparing to move to new highs. At this point, volume data must be examined as well. An increase in volume during a bullish MACD crossover validates buying interest. MACD crossovers that are not accompanied by rising volume often result in weak and temporary upward moves. However, if volume supports the move and the crossover coincides with the pattern breakout, the upward movement is likely to continue with much stronger momentum. We need to see the MACD cross.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.